In this recording, we're going to focus on different variables that a business faces and what happens when some of those variables change. What impact does it have on the numbers? So we'll start with business variables, things like changing cost levels or changes in demand. Then we're going to look specifically at exchange rates. There's quite a lot going on here and it's fairly complicated, so it's something we'll go through slowly and thoroughly. And then we're going to have an example question to put it into practice. Business variables, first of all. Now, hopefully the first of these you'll be well aware of from previous studies. Fixed costs versus variable costs. Do you remember what the difference is? Well, a variable cost is one that changes with output. So you make more units, you have more cost. Things like material costs are very often variable. Or thinking in your own life, something like your phone bill. When you make more phone calls or you use more data, then you pay more. That's different to a fixed cost, isn't it? A fixed cost doesn't change with output. That's something like your rent. Now, it's worth noting that fixed costs can change. So your rent can go up, the landlord can put up your rent, but it's not because you've made more units that you're paying more rent. So it's not that it's varying with activity. Next, changes in demand. Now, hopefully this is going to appear really straightforward to you. So when you have a change in demand for your product, as in you're selling more units, that affects the amount you're selling, the sales volumes, but it also affects your variable costs, because if you're making and selling more units, you're making more output, and therefore those costs go up. They don't impact fixed costs though, do they? And something else to watch out for in these business variables questions is whether they're asking you about profit or cash. So make sure that you read the question really carefully, because it can impact when or what the numbers turn out to be. So some example calculations now. We're told this company is forecasting its profitability for the coming year, Beagle Corp. Sales demand is going up by 8%. So we're going to sell 8% more units. And operating costs, which are all fixed, are rising by 3%. And it tells us the cost of sales are variable. Interest rates on its loan, it's got a $5 million loan, will rise by 0.5% to 6.5%. And it wants us to forecast the profit before tax, PBT, for the coming year. And here are its existing numbers. So it's got an existing PBT of 5.1 million out of revenue of 10 million. So pause the recording here and have a go at doing this calculation, and then we'll compare notes. So I've set up a little working column here, and I'm just going to work through my numbers in order. So revenue, that's going to go up by 8% because sales demand is likely to rise by 8%. My cost of sales, that's also going to go up by 8% because it tells me that costs of sales are variable. And that means I can just fill out the gross profit there by taking the cost of sales away from my revenue. Then the operating expenses, we're told that those are all fixed, but they'll rise by 3%. So I'm taking last year's number and adding 3% to it. And then the final number that needs to go in is around interest. So the interest rate is 6.5% on a $5 million loan. So I'm taking $5 million and timesing it by 6.5% to get to an interest figure. And when I do all of the adding up, I get to 5562. So profit is increased. If you got it right, really well done. Lots of fiddly little calculations in there, so good on you if you got those all correct.